tough day in the Indian currency and bond markets. The currency hitting another low less than a month after it took out the psychologically important 70 level. We're now within striking distance of 73, 72, 74 was the low of the day, although we closed a little bit above that. Trying to make sense of what has changed in the currency markets. And this is a year-to-date chart, which will tell you that the initial set of depreciation that we'd seen was a fairly glide path kind of depreciation. And that's why there was no concern in the market. There were people who were talking about the level of the rupee, at what level does it work best for the economy, etc. All of those conversations were going on all the way until about the end of July or so. You wouldn't have heard anybody being particularly worried about the currency, including government officials, till about the end of July. Things have changed since then. Of course, we had that one major gap up to 70 on around the 16th of August. And since then, look at the pace of the depreciation that you've seen. You've taken out 72, you're at 72.69. That was the close. You went to about 72.75 in intraday trade. So the pace of depreciation has certainly changed. Some people say that it is being driven by the NDF market, which in turn is being driven by the emerging market currency complex. But be that as it may, you have to take note of the fact that the pace at which the rupee is depreciating has changed, and hence perhaps the analysis of it needs to change as well. Just to give you the numbers so far, on a month-to-date basis, you're down about 5% on the Indian rupee, 5.3. That's a one-month comparison across the Asian basket. And if you look at a year-to-date comparison, we are now down more than 12% depreciation. As I was coming in to do this analysis, the real effective exchange rate numbers came in. Those are down to 114 on the 36-country trade-weighted real effective exchange rate. So we've depreciated nominal terms and in real terms. The question to ask is, what is going on in the market right now? Yes, there were fundamentals, current account deficit, etc. The oil price story has been playing out. All of those are known unknowns, if you want to call it that. In the last month or so, what is driving the rupee? Is it oil? Is it the dollar index? Is it expectations? I think it's a combination of all three. Yes, oil has remained elevated. The dollar index last few days has started to pick up as well. And the expectations in the markets have changed, with people talking about 70 to 72 being a band. And then, of course, markets do, outstrip those expectations, and they do stretch in either direction. So perhaps there is some of that happening as well. The reason it's starting to become a little bit of an adverse feedback loop is because it's moving into the bond markets now, and that's creating its own set of complications. So today, for instance, you had the 10-year bond yield go up to 8.18%. Look at this one-month chart of the yield. We were at about 770 odd levels, and you're now at 820. What has changed so much? Yes, inflation expectations has changed, but does that mean that you've gone from an expectation of 2 rate hikes, maybe 3 in this cycle, to 5 rate hikes? I don't know. The swap market seemed to be pricing in another 75 basis points in rate hikes. That was according to B. Prasanna of ICICI, who spoke to us earlier today. But to justify that, you would have to see the MPC change its inflation targets quite dramatically. There was some talk today in the market, just speculation of the possibility of an emergency rate hike. That seems fairly unlikely for a whole host of reasons. The reason we are saying that is, even if the RBI feels the need to intervene in the currency markets right now, it has a whole host of other options before it gets to the emergency rate hike. Quickest thing, or the thing that they tend to do first, is open a separate window for oil companies to take dollars. They have not resorted to that yet. As a second step, you could perhaps resort to foreign currency deposits. To be able to justify a rate hike will be difficult, because Urjit Patel, 2 policies back, had said that they do not use interest rates to defend the currency markets. The interest rate story is driven purely by the inflation target mandate of the MPC right now. And as an aside, I just want to mention that we are in an MPC regime. So should there be a condition where you needed an emergency rate hike, you'd have to first call for an emergency MPC meeting. So for all of these reasons, I think the market is sort of overstepping and starting to talk about expectations which may not exactly come through right now. Having said that, there has been a change in the mood. What was being seen as a needed depreciation in the currency is now starting to look like something that is being driven more by expectations and perhaps fear than actual and only fundamentals.